Welcome to SWBC's Uncharted Wealth podcast, where we help you navigate retirement with clarity and confidence. I'm Mike Walters. I'm a wealth advisor and a certified financial planner here at SWBC. What if giving during your lifetime could actually improve your financial plan? Not just by helping somebody else, but helping yourself too, right? Most people think of charitable giving as just like writing a check at the end of the year just to lower their taxes, but that's not really a strategy. That's a reaction. Now, I mostly find that people are very generous, but they're just not being intentional with it. When you align your wealth with your values, not only can you give more, but you can make a bigger impact and do it a lot more efficiently. Let's talk about how people are giving, okay? Because you want to do it smarter. Most people are defaulting to cash because that's the easiest way to do it, but appreciated assets can be a lot more powerful. So if you're donating stock or ETFs, mutual funds, whatever's in your taxable account, you could avoid capital gain taxes entirely and still get a deduction for the full value. So it's the same gift that you would be doing with cash, just a lot better outcome. Now, what about the timing? Okay. Fewer people are itemizing today because of the way standard deductions have been increased since 2017. So a lot of those donations that people are giving, they're not really getting any type of tax benefit. So if you want the benefit, you have to actually plan for it. Now here's a strategy that I use with quite a few clients. It's called bunching. Okay, you're combining multiple years of giving into just one tax year so it can push you over that standard deduction threshold. And that way, your charitable giving is actually giving you the benefit. Another big way to give nowadays is called a donor advised fund, or a DAF, D-A-F. Think of it as like a charitable bucket. You contribute now, you get the tax deduction now, but you don't actually have to give to the charity in the same year that you do it. Those funds can actually get invested over time, and then whenever you're ready to make the gift, you can. So it separates the tax decision from the giving decision. Another strategy for those that are age 70 and a half can do something called a qualified charitable distribution. Now, it's similar to like an RMD, right, where you have to take money out of your IRA. But once you turn 70 and a half, you can actually give directly from your IRA to the charitable organization. And so you're not realizing that income, and you can still take the tax deduction in that year. Means lower taxes, potentially lowering Medicare costs, and just giving you better overall efficiency in your plan. Now for today's uncharted territory. Now let's take this a step further, because this is where charitable giving really starts to become a planning tool, not just a year-end decision like we talked about earlier. For people that have larger portfolios or these highly appreciated assets that we were talking about, there are ways to structure giving so that it actually creates income while still benefiting the charity. Okay? The example I'm talking about here is a charitable remainder trust. And without getting too technical on all the details, the idea is this. You contribute assets into the trust, you get a partial tax deduction, and then the trust is going to pay you income over time. Then whatever's left is going to go to charity. So now you've turned a donation into income, tax efficiency, and the long-term impact that you were wanting. Another angle, and one that I think is just really underutilized, is using charitable giving as part of your broader income strategy in retirement. So if you've got a mix of account types like pre-tax, which is like 401ks, IRAs, you've got Roth, and you've got these taxable brokerage accounts, you can be a lot more intentional about where those charitable dollars are coming from each year. So maybe one year it makes sense to do a QCD, like when you got RMDs happening. Or another year, it makes sense to use some of that appreciated stock to donate. Another year, you're funding your donor advised fund when you have really high income. When you start thinking about it this way, in terms of flexibility, charitable giving isn't a separate decision anymore. Now it's part of the entire integrated plan. So at the end of the day, Charitable giving creates impact beyond your own life, but intentional giving makes that impact significantly bigger. So here's the question you need to ask yourself. Are you giving in the most efficient way possible? Because if not, you're leaving opportunity on the table. If you want help with that, the SWBC advisors can walk you through it. And if you don't know already, we are now on Spotify. So if you're listening to us there, please make sure to leave us a 5-star review. And if you're still watching the video and looking at my pretty face, leave us a like, comment, subscribe. Make sure you share it with your cousin, sister, auntie, grandma, whoever that you really care about. That's who you want to share this with, okay? So, as usual, nothing that I said is to be taken as legal, financial, or tax advice, and all my opinions are my own. We'll see you next time on Uncharted Wealth. Peace. King Julian is my absolute favorite character in Madagascar. Mart. What?
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.